This is part 3 in our short-term business decisions series, and here we're going to be discussing the setting of prices. So when we set prices, we have to understand what our target profit is. That's number 1. Also, you have to realize or understand what exactly customers will pay for your product. So you'll have to do some research to find that out. And then you have to determine, are you a price taker or are you a price setter for this particular product? So let's go into that a little bit deeper, price taker and price setter. If you're a price taker, then your product is not going to be unique. There will be intense competition for your product, and we're going to have to emphasize what's called target pricing, and we'll look at that in just a second. If you're a price setter, your product is going to be unique. There'll be less competition because you do have a unique product, and you will have to emphasize what's called cost plus pricing. So let's start with the price setter and what's called cost plus pricing. The formula to calculate cost plus pricing, we will start with what's called our full cost, so the cost of our product. To the cost of our product, we're going to add our desired profit. So full cost plus your desired profit is going to give you what's called our cost plus price. If you are a price taker, you're going to use what's called target pricing. Now this is where the terminology comes in handy for you. If you're a price taker, you are now going to take the cost plus price from the price setter, which is also called the market price. And from that, you're going to subtract your desired profit to give you what's called your target full cost. So the cost plus price for the price setter, the higher the better. The target full cost for the price taker, the lower the better. So let's look at an example of a price taker and a price setter. Bennett Builders builds 1,500 square foot starter tract homes in the fast-growing suburbs of Atlanta. Land and labor are cheap, and competition among developers is fierce. The homes are cookie cutter, with any upgrades added by the buyer after the sale. Bennett's cost per developed sublot are as follows. So we have land of $54,000, construction of $122,000, landscaping of $5,000, and variable marketing cost of $3,000. Bennett Builders would like to earn a profit of 15% of the variable cost of each home sale. Similar homes offered by competing builders sell for $200,000 each. So if we added up our cost here per developed sublot, the land, construction, landscaping, and variable marketing cost, that would give us $184,000. That's what those add up to. So keep these numbers in mind. What approach to pricing should Bennett Builder emphasize? Well, they tell us in the problem that it's cookie cutter houses. So that would tell us that it's not a unique product, and we probably have severe competition. So we would be a price taker, and we would have to emphasize target pricing. Will Bennett Builders be able to achieve their target profit levels? Well, to do this, we're going to take the market price of similar homes, which they tell us is $200,000 because we're a price taker. So we have to take the price, the market price from the price setters, which is $200,000, and we're going to subtract our target profit. And they tell us that our target profit is 15% of our cost. And remember, our cost was $184,000. So 15% of $184,000 is $27,600, giving us a target cost of $172,400. but we know our actual cost is $184,000. So we will not be able to achieve that 15% profit.